Hi, welcome back. In this session, I want to move on and talk a little more specifically about risk, but with the easier of the two financial asset classes, bonds. The conventional wisdom is that bonds are safe, but that turns out to be too broad a brush. As we will see in this session, you can have a bond that's riskier than an average or a low risk stock, and we have to talk about where that risk comes from. So to start the process, let's think about the risk you face as an investor in a bond. And this is the same risk you face when you lend money to somebody else. Now, in a conventional bond, you are promised fixed payments in the future, called coupons. At the end of the life of the bond, and bonds usually come with a finite life, you're given the face value of the bond back, the amount that was borrowed back. See what can go wrong. First, even though the payments, the coupons are fixed and the face value is fixed, if interest rates change after you bought the bond, the price of your bond will change. We'll talk about how much and which bonds are more exposed, but there's price risk coming from interest rate changing. So think of that as risk in interest rates, and you're going to face that even if you buy a bond issued by an entity that has no default risk. Now, if you add default risk to the mix, that's a second risk you face. You've been promised fixed payments, coupon payments, but those promises might not be delivered. The greater the risk that they will not be delivered, the greater the default risk, the greater the chance your returns will be volatile as a consequence. So interest rate risk and default risk drive the risk in a bond. Let's start with interest rate risk. The coupons and the face value of a bond are set at the time of bond issuance. So when you buy a bond, you know there are 8 years of coupons, or 15 years of coupons, or 30 years of coupons. You know when the coupons will come. And you know the face value of the bond, usually $100, $1,000, whatever the set face value is. Those are the promised cash flows. Let's take default risk out of the example for the moment. At the time you buy the bond, let's say interest rates were 3%. And that a year later, or even 6 weeks later, rates have risen to 4%. Your coupons haven't changed, your face value hasn't changed, but the price of the bond is going to change because the value of the bond will reflect the present value of the coupons, the face value at whatever the interest rates are at the time you price the bond. So if interest rates go up, the price of the bond will go down. If interest rates go down, the price of the bond will go up. By how much? Let's take a very simple example. Let's suppose you have a 4% 10-year coupon bond. And the face value is 1,000. So you promise cash flows of 40, and let's make the coupons annual. So for the simple reason that it keeps life a little simpler. It could be semi-annual. Nothing will change the example. There'll be a mild change in present value, but let's act as if the coupons are annual. $40 every year for the next 10 years. At the end of the 10th year, in addition to the 40 in coupons, you get 1,000, the face value. I've computed what the value of this bond will be at rates ranging, or if interest rates range from 2% all the way up to 6%. Let's take the easiest scenario. If the interest rates are 4% and the bond is issued at the time, interest rates are 4%, the price of the bond is going to be 1,000, face value. If interest rates are 2% though, the bond price, because the present value of the cash flows will be higher, increases to 1,180. That's an 18% increase in bond price because rates went down. Conversely, if rates rise to 6%, the price of this bond drops to $853. You can see that the price of the bond will vary depending on what interest rates are. Just as an aside, in 2022, a 10-year treasury bond, so no default risk, dropped in value by roughly 20%. You know why? Because interest rates that year went from a really low number, less than 2%, to close to 4%. When interest rates change, the price of the bond will reflect it. Now, if you look at this example, you can already see what will drive that percentage price change. The higher the coupons of the bond, the less exposed it is to interest rate changes. Why? Because the higher coupons allow you to get the cash flows quicker. If coupon rates drop, the coupon on the bond becomes lower, the bond will become more sensitive to interest rate changes. At the limit, if you have a zero coupon bond, where you have no coupons at all and only the face value at the end of the 10th year, the bond will be the most sensitive. So the level of coupons matters. The maturity of the bond matters. A 30-year bond holding all else constant will be more sensitive to interest rate changes than a 10-year bond. And a 10-year bond will be more sensitive than a 5-year bond. One way to capture both the coupon level and the maturity is with a measure called duration. What is a duration measure? Duration in many ways is just a weighted average of when you get the cash flows of the bond. So as an example, if it's a zero coupon bond, it's a 10-year bond, the duration will be 10 years because you get all your cash flows at the end of 10 years. As you start to add coupons on, the duration for a 10-year bond will get less than 10 years and it'll drop the higher the coupon on the bond. And you're saying, that sounds abstract. Let's take a 10-year bond. That, in fact, the 4% 10-year bond that we looked at earlier, and compute the duration of the bond. This is the simplest measure of duration. It's called Macaulay duration. Here's what I'm going to do. I'm going to first take the present value of the bond, of the cash flow in each year. So that's just the present value of the cash flows to today. And then I'm going to multiply the present value by when I get the cash flow. So year 1 cash flow, I'm going to multiply by 1. Year 2 cash flow, I'm going to multiply by 2. If you add up that last column, you get 7,714, and you divide by the present value of the bond, you get a duration of the bond of 8.36 years. That incorporates both the coupon and the maturity. The higher the duration, the more sensitive a bond is going to be to interest rate changes. Let's bring in default risk. When you buy a bond, you're promised a coupon, but that promise might not be delivered. Your best case scenario of the bond is you get the entire coupon. You don't ever get more than the coupon, no matter how well the borrower is doing. Your worst case scenarios, though, range the spectrum. Your worst case scenario of all is you receive none of the promised cash flows. The potential for upside is limited. The potential for downside is very large. And I'm going to draw a proposition that comes from that characteristic of bonds. Because of the asymmetric risk that you get lots more downside than upside risk in a bond, with bonds, we measure risk by looking at only the downside risk or default risk. With equities, you'll see why we bring in the upside. With bonds, it's mostly downside risk. So what is it that drives default risk? 3 things. First is the capacity to generate cash flows from operations. A business that's able to generate more cash flows from operations will have less default risk than one that generates less cash flows. And the one that generates less cash flows will have less default risk than the one that creates negative cash flows. That's the first. The second is the volatility in those cash flows. You take 2 companies with exactly the same cash flows. A company with stable cash flows will have less default risk than one with more unstable cash flows. And to the extent that you have other fixed commitments you have as a company, lease commitments, contractual commitments, that adds to your default risk. For as long as people have been trying to lend money, they've been trying to measure default risk. And there are 3 broad measures of default risk you will find. The first is a measure we run into as individuals or as business, which is a credit risk score, where people look at your age, your income, your wealth, and they assess a credit risk score. Sometimes we think it's unfair, but as lenders, you can see why a credit risk score helps you determine what interest rate to charge a borrower or whether to lend them in the first place. The second, and this is true for corporations or publicly traded companies, used to be primarily in the US, but now across the world, is a rating. There are ratings agencies out there, and we can debate how good or bad they are, whether they're biased, S&P, Moody's, Fitch, etc. And what these ratings agencies do is they look at publicly traded companies, they collect information for these companies, mostly public information, but sometimes information that they get from the managers, and they assess a default risk for that company with a rating. The ratings are letters, not numbers. And they range usually from AAA, which is the safest you can be as a company, down to D, where you're in default. There's a third way in which you measure default, which is relatively recent. Over the last 20 years, there's a market that's developed called the credit default swap market. What does it allow you to do? If you're somebody who's bought a bond and you're worried about default risk, it allows you to buy insurance against default risk in the form of a CDS spread. What is that spread? If that spread is 1.5%, and you bought this on a bond where you collected 6% coupon or an interest rate, you pay 1.5% to 6% every year to insure yourself against default. You can see what this gives you, right? It gives you a market set number for that default spread given your default risk. Credit risk scores, bond ratings, default swaps. Now in this graph, there are 2 things I try to illustrate. First is that the ratings agencies for the most part get it right? So if you go from AAA down to D, and these are both Moody's and S&P's, you can see that the default spread widens. So for the most part, much as we abuse ratings agencies, they get the rating right. The other thing to note in this graph is how default spreads vary over time. Let's take a triple B rated company that remained triple B between 2021 and 2025. In 2021, the default spread for that company was 1.71%. In 2023, that default spread had jumped to 2%. And in 2025, the start, it had brought back to 1.2%. At the risk of stating the obvious, default spreads can vary across time as the economy shifts, as you go from more scary times to better times in the economy. Now, what do ratings agencies look at to come up with their assessments of ratings? Much as we like to attribute all the special information they have, for the most part, ratings are based on information that's publicly available. In fact, they're based primarily on ratios you can compute for companies. The ratio that I find most useful in explaining difference across ratings is called the interest coverage ratio. You take the operating income and divide by interest expense. The higher that number, notice as you look across the top line, the higher the rating of the company. So for rated companies, you're trying to explain ratings, look at the numbers first. The answer usually lies there. Now, there are companies out there that are not rated. Smaller companies in the US, a lot of non-US companies. And for those companies, you can assess default risk by coming up with your own version of rating, acting like a ratings agency. In fact, let's take a simplistic version of how the ratings agencies attach a rating. Say you compute an interest coverage ratio. You should be able to do that for any company anywhere in the world. You take operating income, earnings before interest and taxes, and divide by interest expense. If you have a company with $3.5 billion in in earnings before interest and taxes and interest expense of $700 million, your interest coverage ratio is 5. You say, what do I do with that? I have a lookup table where, based on rated companies, if you tell me what your interest coverage ratio is, I can tell you what kind of rating you should have. So the company you're looking at is a smaller company with an interest coverage ratio of 5. Their rating should be single A. At least at the time this table was put together, the default spread should be roughly 1%. So whether it's with actual ratings, synthetic ratings, credit default spreads, or credit scores, you should be able to assess the default risk in a borrower, and from that come up with a spread that goes with it. So here's the bottom line when it comes to risk in bonds. While we generally describe bonds as safe, there's a huge continuum of risk in bonds, and they can vary based on both the maturity and the coupon of the bond as well as the default risk in the bond. So if you have a bond with no default risk, that bond can still be risky to a short-term investor because the price of the bond can change as interest rates change as well. So when you walk into a bond investment, it's good to be aware of both interest rate risk and default risk and factor them into your decision making. I hope you found this session useful. And in the next session, we'll move on to looking at risk from an equity investor's perspective.